Nick Papanicolaou. I run brand and business development for new brand ventures for Pernod Ricard USA. And I want to talk quickly today about valuation. I'll keep this very high level. This will be kind of Valuation 101, and then hopefully I can do a few more sessions where I get in a little deeper into the nuances of valuation. So Valuation 101 to me, particularly if we're talking about early stage or craft spirits brands, I think really most of the multiples I see are related to what previous or prior transactions occurred at, what multiples they occurred at. And usually those are on a sales multiple. So let's just say it could be 5 times sales. If your sales are $1 million, the valuation will be $5 million. Or they can be on an earnings multiple, such as an EBITDA, which is earnings before interest, tax, depreciation, and amortization, or CAP, which is contribution after advertising and promotion. The problem with those for early stage brands is often these brands are negative cash flow producing, or they're not generating a positive EBITDA. They're not yet break even. So what I tend to see more is people anchoring on a sales multiple, and I think that's fine. There are caveats to it, but I'll save that for Valuation 201. So again, I think sales is a commonly used metric. I want to also mention why I think valuation is important, but why I think sometimes it's not so important and people get way too stuck on it. So obviously I think it's important because in any kind of partnership, you want to make sure that neither side feels that they got the worst end of the deal. You want a fair valuation so both parties feel, well, actually in the entrepreneur's case, they feel that they are paid and valued for the work that they did to date. And in both groups' cases, both the entrepreneur and the partner or investor feel that going forward, they're going to be compensated for the work that they do, for the value that they add to the partnership. So that's one of many reasons why it's important. I think the flip side of that is that I see way too many entrepreneurs get just so caught up and like hobbled by what the exact number should be. And I'm a big fan of accuracy over precision. I think as long as you're within a range and it's roughly fair to both sides, you should be okay. What too many people do is they get caught up on that multiple or the valuation, and to me that's kind of too singular focused. To me, I equate that to wanting to get a large slice of the pie when in reality both sides should be thinking about how to create a bigger pie together. I think so much of that is contingent upon honesty from both sides in the partnership. Because anytime an entrepreneur kind of overpromises or misrepresents numbers or what they can do, and vice versa, anytime an investor says, "Sure, we can help you with distribution," and then that doesn't work out, or "We can help you, add board level advice," and then they don't want to spend the time on the board, whatever the case may be. Anytime there's misrepresentation or a lack of honesty and transparency, it's bound to end badly. So again, I think kind of really setting at the onset, setting out what each party is providing and why that benefits the partnership as a whole is key to a successful partnership. So in terms of standard multiples, I think in terms of the actual metric, again, price to sales is a pretty commonly used one for early stage brands. In terms of the actual number, I get asked this question a lot, and I tend to not want to answer it because the truth is it depends on so many things. But I will say that if you look at the public companies, you can see roughly what their multiples are. You can see that they trade on a price to sales of this or enterprise value to EBITDA of that. And roughly that should be able to help you figure out why you should be higher value or lower value than those. And valuation is often a way to determine or is determined by the growth estimates of that company. If you think you're a very high growth company and you're growing faster than a public company would, then that might lead you to believe that you should have a slightly higher valuation than a public company. But we've seen, public companies at 4 to 5 times sales kind of going in between roughly that range. And we've seen some of the private companies sell below that. And we've seen some of the ones, the high flying ones like Casamigos, perhaps selling at much higher than that, 17, 18, 19, 20 times are the estimates of that. So it really depends. a lot on the growth prospects, and it depends on the strategic value, but I'll save that for the next session in Valuation 201.